Money management. Introduction. When he blew up 100K at a blackjack table in a casino, customer yelled, "How can you lose 100K at a 10K table?" Another customer replies, "Patience, my friend. Money is what you need to stay alive, to fight another battle, another day for another trade." This chapter is all about money and money management for traders. If not handled well, losses and risk can grow exponentially in no time at all. Ignorance and indiscipline in managing capital can bring down not just you and I, but even the Enrons, WorldComs, and Satyams of the world. So let us see what constitutes fiscal discipline for a trader. Well, there is both good news and bad. The bad news is that neither the system that we share here nor any other system in the whole wide world can promise you risk-free trades or guaranteed returns or a 100% trade success rate. The good news is that you don't need these either. Your success as a trader does not come from being right every single time. One of the key factors in trading the success is money management. It is only through a solid money management system that a trader can build wealth over a period of time. Please note, I am saying a period of time. There is no overnight magic anyway. Okay. So in this, the author is telling about money management. And what do you mean by money management is that if you don't manage the money and you will if you keep losing money, you will not have enough money to fight another day. So that is what money management is all about. And if you don't handle your money properly, what will happen is losses and risk will keep on growing exponentially and in no time at all. So, and what are the reasons for that? Why losses and risk will grow accumulately? Only because if you are ignorant or if you are indisciplined in managing the capital. This will bring down not just you and I, and he's telling that even people who are uh, these are all top people in bronze and world forms, they themselves have lost their entire empire. So that is what the author is trying to tell here. And there are good news and bad news. And the bad news is that uh, whatever trading system you follow, they will still they are not 100% successful. Okay, there is no trading system which is 100% success having a 100% success rate. Okay, but the good news is that you don't need a 100% success rate trading system. That is what author is trying to tell. It does not mean require that you have to have a 100% success rate trading system. If you manage your money well, and we can actually build our wealth over a period of time. So the author is telling there is no overnight magic. What is money management? Well-timed entries and exits are a trader's way to defend his capital. This game is first about capital preservation, followed by capital growth. Ashwani, Gujral. Trading is not gambling, and neither should it be treated as such. It is a business, and every business has to have plans for funds management and cash flow. There has to be a rationale behind every decision pertaining to funds. Such fiscal discipline is of utmost importance and it must be adhered to every single day in every single trade. Someone has rightly said, to err is human, but if the eraser wears out before the pencil, you might be overdoing it. Someone else has also said, to forgive is divine, but Dalal Street doesn't take this seriously. It never forgives. So, what is money management? And just like any business, trading is should not be like a gambling. It should not be treated like a gambling. And just like any business, you have to manage funds and cash flow. You also have to manage trading in the same manner. So, and you should know when to enter and when to exit. Okay, and the whole game is about not losing the capital first and not just about capital growth. So every decision which you take, there has to be a decision, there has to be a rationale, and that discipline should be there in every single day, in every trade. Every time when we make a trade, we have to ensure that there is a rationale, that we are not going randomly going doing a trade. An author also says that you know you can make mistakes, but if you keep making mistakes, you before you keep writing a lot of things, and before you can erase it, and we might be overdoing it. And you know the divine might forgive, but Dalal Street, the market does not care. It never forgives. Every trader who is serious about building wealth in the market has to adhere to principles of money management. This adherence ensures your long-term survival in the game. Failed trades are part of a trader's daily life. Even every trader will have his share of these. Nobody can be right all the time. When you are clear about your money management plans and when you strictly follow those plans, you survive and thrive in this game. Money management will ensure that you never bet beyond your risk capacity. Risk is inevitable, but the amount of risk can be controlled by controlling the size of the bet on each trade. That is exactly what money management does. It tells you how much to bet on any given trade. That bet size is called position size. So, every trader, if we are serious about building wealth, we have to strictly follow money management principles. Okay. And only if we follow the money management principles, we will be able to survive in this game for long. Okay. And failures are part of the trader. Every trader will be failing, and nobody can be right all the time. But when we are clear about our money management plans and we strictly follow those plans, we will be able to survive in this game. And the important thing about money management is you don't risk beyond your capacity. Okay, you ensure that you never bet your risk capacity beyond your capacity. Okay, so every trade has a risk. When we tell about risk, every time we make a trade, there is a possibility of we losing money. And how you can control that from blowing up your account? By telling how much you have to, you know, put in that trade. So that is called position size. How much you are betting in each trade, that is called position size. Money management is thus clearly not just about stop loss. While we will learn more about stop losses in this chapter, but let us be clear that stop loss defines the risk in a given trade setup. It tells you about the loss or risk in terms of points. You multiply it with your position size and you get the total risk in terms of the amount. Money management, on the other hand, gives you the position size. It answers how much of the stock you should buy or sell. Nevertheless, in order to clearly understand the concept of position size in a given trade, we will start with some lessons on stop loss. So the author is telling that by money management, I am not telling only about stop loss. It's not like, every trade is the stop loss I'll be taking. So that is called as money management. Author is telling that, stop loss, you'll tell it will be about, about the number of points, the how much you can go down, how much from your entry point, right? And what happens is, but how much quantities you are buying and multiply it with the amount of points you are risking. That is actually that will be the total risk which we take, right? And so the stop loss will be like it will come from our trading system. But how much we can lose, that will come from our position sizing. And money management will actually tell you what how to do that position sizing. Okay. It answers how much of the stock you should buy or sell. Nevertheless, in order to clearly understand the concept of position size in a given trade, we will start with some lessons on stop loss. So, the author is telling that how much points you can lose will come from your trading system, stop loss, and all these things. But how much quantities you should buy, so that if you reach that stop loss, you will be able to still be in a managing your money well. So that is what the money management will tell. So that is the position size. But before the author is trying to go into the position size, the author is now trying to shed some more light on stop loss. Stop loss revisited. It does not matter what college professors teach about efficient markets theory. The fact remains that human behavior is driven more by emotions than by logic. People will often behave irrationally. If markets are rational, then I would have been a waiter and not a rich man, said Warren Buffett. Even those who believe and swear by the honesty and capabilities of top managements based on corporate balance sheets do not understand many things. After spending an entire life together, we often fail to know even our own family members well. We expect one thing from past patterns, but we often see unexpected changes as newer life developments take place in our lives. There is always an element of the unknown. So, whatever people teach about the stock markets theory, it does not matter because our human behavior is driven more by emotions than by logic. Okay, and people will often behave irrationally. So that is the normal norm. And the market is actually reflecting whatever people are doing, right? So, and the author is also justifying it by telling that Warren Buffett once said that if markets were so rational, I would not be a rich man, I would be a waiter. And even though some companies will have the top management is fantastic and all these things, uh, uh, they won't understand many things, right? And because even our own family members, we might have been from the beginning spending with them for a long time, but sometimes they behave in a manner which is not consistent, which we ourselves are finding it difficult to understand. So there is always an element of unknown. Every balance sheet can be camouflaged. That's not to say that every balance sheet is camouflaged. All that is being said is that since there are always unknown risks in around, the greater the number of factors we check, higher the chances of getting things right. That is all. So let us accept the risk and learn to use charts as well as money management. Stick to price action. So you may be thinking that if we follow a fundamentally strong company or something like that, management is good or something like that. Even they might you would never know when some company might camouflage the balance sheet, right? And the author is telling not all the balance sheets are camouflaged, but there is still a possibility of something which will go against our expectation. Okay, so the author is telling that you have to accept the risk and follow the charts as well as money management. So money management is more about the position sizing, right? How much you can lose. And the chart is telling that you have lost whatever you are supposed to lose. Stick with that. Don't put too much emotions on, oh, the fund management is good, the company is doing good, balance sheet is good, and all these things, everything is good. Don't do that. If the price action is telling that, it is going beyond, it has broken down, get out of that trade. So stick to stop losses, not to opinions and beliefs. As Gujaratis often say, bhav ej bhagwan. So basically, price is God. So if the price is telling that it's hitting your stop loss, get out of the trade. Don't stick with your opinions and beliefs. Then that is what Northern is trying to tell. Technicals don't lie, people may. So the prices will never lie, people might lie. Stop loss is essentially the difference between your entry price level and the level at which you will exit your trade if it goes against you. It is defined in terms of points and it's derived from technical analysis. Say you enter a script A at a price level of 243 rupees. You look at the charts and decide to exit if it falls below 240, then your stop loss is 3 points or 3. When you multiply it with the quantity of stock that you are trading, you get the total risk or total potential loss per trade in terms of rupees. We strictly urge that the amount of total risk per trade must never exceed 2% of your total trading capital. Okay. So every trade now the stop loss basically the author is telling that at what price you entered and what you will exit if you are wrong. That is your stop loss, right? And you are say assume you are entering at 243 and if it you tell to yourself that if it goes below 243 240 and that is I have a 3 points that is the stop loss. But The more important things is it might be 3 points here, it might 3 rupees, but how much you are buying at 243 and how much you are selling at 240. So if you are buying 1,000, obviously you will lose 3 points. It will be 3,000. So that is, it might be 3 rupees, but if you have bought 1,000 at 243, at 240 it will be 3,000 loss, right? So and that is the potential loss per trade in terms of rupees, right? So that value, right? The author is telling that, you know, the amount of risk per trade that should not exceed 2% of your total trading capital. Okay. So assume now, suppose your total trading capital is 5 lakh, namely 500k. The maximum permissible risk or loss per trade must then never exceed 2% of this amount, namely 10,000. Only in very exceptional cases, when the market is clearly trending and so is your stock, and when the volumes are high and trend is young, and when the local and the global setup are all in your favor, should you allow a minor variation and permit yourself to raise this limit up to 3%. This must not happen every now and then, only exceptionally. This variation in total amount is allowed due to increased volumes that one may want to trade in clearly trending markets and not due to a wider stop loss in terms of points. You will understand this more clearly as we proceed. Okay. So assume if your capital is 5 lakh, okay, and others telling that stick with 2% per trade, right? So at any trade which you take, you should not lose more than, 10,000. That is 2% of 5 lakhs is 10,000. So you might, so this is like the author is telling per trade. He's not telling in terms of the capital. You might deploy 1 lakh per trade, or you might deploy 50,000 per trade, right? So at every trade which you do, ensure that it is not going, you know, 10,000. So based on that, you might have your stop loss. And so based on that, you have to choose your position size. So if you're going to take five different trades, then five different stocks which you're purchasing, so you have to modify your position size in each of these things with our price action and with our where the stop loss should be, and then ensure that that is still not exceeding 10,000. That's what the author is trying to tell. So based on that, our position size should be there. How much we allocate uh, per trade per script, right? So and the author is telling that in very exceptional cases only you have to, and what are all the exceptional cases? When the market is clearly trending, right? So it is going forming higher highs, and so is your stock. Obviously, our stock is also trending, and the volumes are very high. It's not just going higher high; the volume is also very high, and the local and global setup are all in your favor. And obviously, we are on a bullish market. The whole global setup is also in a bullish market. And then at that time, maybe the author is telling that if you enter at the wrong place somewhere, then stick with, you can exceed little bit to 3%. Okay, and it should not be like, every time you keep in, making it 3%. This variation in total amount is allowed due to increased volumes that one may want to trade in clearly trending market. So in a trending market, obviously you will little bit put more money. So obviously as a result, um, even the 3 points, if you are say putting, if you are buying like, instead of 3,000, you buy 4,000. When it goes 3 rupees down, it will be down by 12,000. But it is a very trending market, so that is why you want to capture. You are risking more. So that is what the author is telling. You will understand this more clearly as we proceed. On the other hand, when the markets are sideways and when the volumes are thin as well, you can even restrict your position size to 1% loss of capital per trade. Okay. And for more than 90% of your trades, you must stick to the 2% permissible limit risk per loss per trade. This risk or loss per trade on total trading capital. For all trades, irrespective of the lot size, 2% means 2%, whatever the lot size is, period. So, The author is telling that if it's not trending, if it is very sideways, then stick with 1%. If it is going 1%, uh, against your direction, get out of the trade. And for most of the times, you just stick with 2%. 2% means 2%. Okay. When the market is sideways, you can stick with market is sideways and volumes are thin. Okay. You can restrict your position size to 1%. Okay. And all other times 2% means 2%. Okay. Deriving the stop loss. Stop losses are like condoms. If you refuse to use them, you may be left holding the baby forever. There are traders who decide stop losses on the basis of their willingness to lose money, either in terms of percentage or amount. They use the amount that they are willing to risk every trade they take to derive the stop loss. Okay. So how to come up with these stop loss? So first is author is saying that if you don't put your stop loss, it's like condoms. You have to, you know, keep holding the baby. That's what will happen. And there are some traders who will take the stop loss based on how much they can lose. Okay. And say for example, today I can lose 10,000 or 5,000, and that will be my stop loss in my mind, and that is for every trade I am ready to lose that much. That is one way of deriving the stop loss. The next one is there are traders who will accept X% of trading capital as acceptable loss for every trade they take. This person may have nothing to do with technical analysis, chart patterns, or tools. So it's more like, author will, some people will simply take, I have 5 lakhs capital, I'll be 2% of that, 10,000. I don't care if my stop loss is very wide or narrow or something. I'll just go with these two values. So some is like, this is like I don't have any fixed number. I have fixed number, this much I can lose. This is like I have total capital and this much percentage I can lose. And there are some people who will be like, stick to fixed rupee stop loss for every trade and they exit a trade if the loss mounts to that level. And it's the same. Like, some people will tell that, I will, if it goes 10 rupees lower than my purchase price, say for example, if it goes from 243 to 233, then I will exit. Okay. So this is like the total amount. I will lose 10,000. Randomly, I'll come up with one number. Here it's like, and I will randomly come up with some percent. And here it is like, I will randomly come up with some, individual price decrease. All such methods are of determining a stop loss are random. The market does not care what your risk appetite is. It does what it is best at doing. It is neither your friend nor your enemy. It is neither aiming at forgiving your mistakes nor determined to give you any favors. It is just doing its stuff. If there is any problem, it is with you. It is within you and your system. So all the three things, we are all taking it based on our own gut feel, right? Basically it's our own opinion. This person's opinion is like, he is ready to so much money, and he's like, I will so much percentage, and he's like, I will lose so much money. But what is the connection there? So he's telling, author is telling everything is random. These are all not the right way of determining a stop loss because the market will not care for how great risk appetite. If it is decided to go down, that's all. It doesn't care that whether you are a very great risk player and all. It is neither your friend or it is neither your enemy nor your enemy, right? And it will never forgive nor it will give you any favors. So it is just doing its stuff. If there is any problem, that is only within you, and it is within you and your system. The stop losses must come from the market technicals and not from your mood of the moment. Yes, as day traders, we can keep time stop losses. That is, you may choose to exit a trade if it is taking too long to work out. That is also because a good trade will work from the word go. If it stalls for too long, you might be missing out on better alternate opportunities. For day traders, it is very important to time their trades well. Entering too early means wasting time as well as losing other opportunities, while entering late means bigger risk. you must try to get not just the trade direction right, but also the timing. As futures and options traders, you are betting not just on the direction, but also on the volatility and timing. So the stop loss levels must be derived on the basis of some logic. So the author says that all these methods are wrong, and you should not uh, keep your stop loss based on your risk appetite or how much I can lose. You should basically look at the chart, and from there only you have to it has to be arrived, right? So not based on our mood of the moment. Okay. And there is also as a day trader, because we have to keep time based stop losses also. Okay. What is time based stop losses? If you are entering and it is taking so much time, you are losing opportunity, right? Or if you entered at the wrong time and you're hoping that it will go in your direction, that is also not a great thing to do, because the author says that from the time if you entered, it should start working in your direction. And if it is not going in your direction and if it is stalling for long, we might be missing. So it is authors telling quickly get out of that particular trade, because there are better alternate opportunities which might you might be missing by trying to make that trade work. And if you enter too early, right, so you should enter the right time. Okay, so and if you enter too early, then we have to keep waiting for it, hoping. So you should just enter, because in FNO there is not just uh, time. The time matters, right? And for an option buyer or something, there is not just uh, price. There is something called momentum, right? So the acceleration. So unless if you don't enter when the acceleration is happening and exit when the cool down is happening, we will be waiting for the price to go up, and there will be time will be wasting. It will there will, and the time decay will will play against option buyers. So, and how to come up with the stop loss then? This logic can be high and low of the entry candle and nearby swing high low, as we kept in our buy sell trade setups in the examples in this book. So one way is to when you enter, if the enter that candle it is breaking the low of that particular and exit, or if in that particular, basically you can have the in that particular candles high or low, or there is a swing. If you might have entered in a swing low or high and have that as particular as the, what is it called, the stop loss. But based on the previous examples in this book, this is one way of arriving at a stop loss. Okay. And it can also be the pattern low for those who trade chart patterns such as head and shoulders. So sometimes there is a head and shoulder pattern, and if you are trading a pattern like that, then you can wait for that particular pattern lows to break. If it breaks that particular pattern's low, then it is obviously going against you, and you can exit that particular trade setup. And yeah, the third one is it can be some volatility based stop loss, such as below the moving average lines, like we did in the trailing stop loss technique. So in the previous, there is some one way you can do is you can, whenever the moving average lines are being broken, then obviously you can exit the trade. So the point is that the stop loss must be arrived at some logical levels and not from your whims, fancies, dreams, desires, fears, greed, or any other emotion. You cannot say that you will keep the stop loss at say 5% just because you feel comfort in that. The market does not care about your comfort, nor about what you think. You must control risk by following trade logic. That is how you better the chances of seeing your stop loss levels sustain. If the levels still do not sustain, you must get out. At such times, the market is trying to tell you something and you ignore its message at your own peril. So, if the market is going against you, get out of that particular trade, right? You cannot tell that, I'll have 5% because I'm comfortable with that or something like that. Uh, if it is not sustaining, you should get out. And the market is trying to tell you something, and we are ignoring because obviously at our own peril. Stay with the trend and stick with the stop losses. Leave the past and live the future. Okay. So whatever has happened, ignore it. Try to see what is going to happen in the future, and always stick with the trend and stick with your stop losses. All scripts are different, so must the stops be. The value of stop loss in terms of points will vary with each stock. Some stocks have lower volatility and smaller candle formations. Accordingly, these will have smaller stop losses. Other stocks with higher volatility and bigger candles may have a wider stop loss in terms of points. The position size in each of these will vary accordingly. Lower the volatility, the smaller will be the stop loss in points, and higher the position size that you may be able to afford with the same amount of total risk. It is also possible that some F&O contracts may simply not fit your account size. You have a choice to reject those. Exercise the right. Make a choice. Every stock is different and each stock should be looked at differently. Each comes with its own level of volumes, liquidity, volatility, risk, and returns. Not everything may be right for you or suitable for your account size. Have a look at table 12.1 for clarity. If you fail to follow these principles, then you may be causing yourself not just monetary damage, but something even bigger. Understanding this table is crucial. The cost of ignoring it can be very high. So before we go into the table, we'll just briefly see. Author is also telling each scripts are different and how they behave is different. So the stop loss must be also be different. For example, Nifty is not very volatile, but Bank Nifty is very volatile. So based on that, your stop loss also should be right. If it is the volatility is very lower, you can have smaller stop loss, and you can add more. Uh, what is it called? Position size. More you can buy more, and that again should also be based on how much the 2% risk. And there are some F&O contracts which are very huge. Say for example, futures, the one future itself very huge, and obviously we don't have to buy. So every stock is different, and there are some stocks which are trading at very high uh, uh, price also. So you can actually ignore all these things. So everything will have its own volumes. Some will be having trading at a large number of volumes. Some will have, as a result, you will have more liquidity, and some will have more volatility. Some will have more risk, and some will have more reward. Obviously, the more the risk, more the reward. Less the risk, less the reward. So, and we have to choose that particular script based on our account size and based on our appetite. And now we'll go to the table. Okay, so in there is a script A and script B. The current market price of script A is actually 102, and the current market price of script B is 1500. And how much you are affording stop loss in the script A? It is 2 points. But in this case, you are actually increasing the points for because it's a huge thing. Obviously, there will be a little bit more volatility. So you are actually having a stop points of well. Now the total capital which we have is 4.5 lakhs in both these trades. And so 2% of this 4.5 lakhs is 9,000. So how much? So you can actually lose 2 points. So start from your stop loss and you tell that, I can lose up to 9,000. So you can actually 2 points means so you can actually buy 4,500 quantities, right? So two times it goes after your purchase, you will actually make 9,000 loss and get out of the trade. But what is the minimum allowed in the contract size? It's 5,000. So don't avoid this script. Okay, so don't take the script. Or take this particular thing here also same 9,000 is allowed stop loss, and so you can take actually only 750, and you can take a maximum of 750 quantities. And what is the in one particular contract you can actually take 600. So that is the obviously the next one if you want to take it will become 1,200. So stick with one particular contract, and so basically you are actually 600 into 1,500, right? So that is 9 lakhs. So that is the value which you are the total value of that particular contract is 9 lakhs. Okay. So as you see, you are buying. That is a beauty of FNO, right? You can buy 9 lakh worth shares using this particular uh, thing. Uh, so fine. Write it down when stop losses get triggered. Write it down in bold letters on all your walls. There is no shame in triggered stop losses. Okay. So there is no shame in triggered stop losses. There should not be any stigma attached to it. It is very normal and it is a part and parcel of trader's life. You can do the following things when it happens to you. Analyze the trade and see if you get thrown out by merely random market noise. If yes, then again two things. First, a good quality stop loss must be wide enough to contain the noise, yet narrow enough to keep you afloat as per money management rules. So check out and if needed, work on your technical know-how going ahead. Placing stop losses exactly where expected is a sure way to get hunted. There has to be some minor amount of buffer, which will depend on the kind of script that you are dealing with. It is its volatility at the time of trade and the chart setup. So, you basically the author is telling that okay, if your stop loss has been triggered, just get out. Don't be ashamed. Okay. Now, and when that stop loss happens, what exactly has happened is your stop loss got hit because of some volatility. Like it hit your stop loss and started going against your on your direction, right? And if that has happened, two things can happen. So one is first of all your stop loss is not wide enough. Then the market kind of hunted your stop loss. They knew that some people knew that your stop loss will be at that particular level, and they kind of uh, pushed the price down by selling more. And once you got exited, they bought back uh, whatever from you, right? So so you have to keep some buffer. Okay, so there has to be some amount of buffer. Okay, so second, if the stop loss was triggered as a result of sudden turn in the market, then see if the turn was short-lived and whether the trend looks intact. See if the move is resuming in the original direction with a decent amount of vigor and volumes. If yes, re-enter the trade. Such traps could give great trades. So sometimes the market would have trend would have changed, right? It would have reversed, and it might hit your stop loss. So author is telling, see if it is again going back in the same trend. Okay, if it is going back, say if you are taking a bullish trade and it comes back, and if again becomes bullish, then the author is trying asking you to re-enter the same trade. Okay, because such traps uh, could give great trades. Okay, if trend resumption seems to be lacking participation or conviction, then it is a good idea to step aside and wait it out. Okay, author is telling don't immediately go and take the opposite trade. Okay, so you have to wait. Don't quickly jump. There is a because usually what happens is there will be and when the trend will be in one direction, there might be consolidation also. So don't quickly jump because the probability of your stop losses will get hit easily in this particular area. And if there's a strong reversal with good volumes, then you can enter in the reverse direction. That can be done provided you have quick enough reflexes and don't get frozen into inaction by a loss. Okay. So obviously, if it is going in one particular direction and is reversing with good volumes, okay, then you can enter in the reverse direction. But you have to ensure that we are quickly, you know, uh, coming up because what happens is the minute we get a stop loss hit, there's a probability of we going into a freeze mode, right? So, and we will not do anything. We'll simply watch, or we'll simply watch our loss going. We won't even exit the trade. Things like that might happen. In either of these cases, keep haste and desperation under control. Okay, it's very important. Uh, don't try to do revenge trading. That is what author is telling. Don't be desperate to get back the stop losses. Don't try to, quickly do an opposite trade. Always be calm and cool and बस ट्रेन एंड ट्रेड अपॉर्चुनिटी एक जाएगी तो दूसरी आएगी याद है ना if one goes others will come down so always remember that if one bus goes there's another bus going to come one train goes another train goes to come similarly a trade opportunity if it's gone now you'll always get another opportunity modifying the stop loss midway very often traders get into the habit of modifying the stop loss in an ongoing trade. For one, they widen the stop loss when they see the price nearing their predetermined stop loss level. They do this with the intention of accommodating wider gyrations before the trend and the script may resume the move in their favor. This is a huge sign of non-professional behavior. Once a stop loss, always a stop loss. There is no question of midway modifications. Other than for trailing stop loss in a winning trade, there is no question of fiddling with these levels. Okay. So, what happens is sometimes we keep a stop loss and then what happens is it will come near our stop loss. So what we'll do, we'll little bit reduce the stop loss from our level because we will think that it might let us accommodate little bit more. Okay. So, but what happens is that is actually a very non-professional behavior. So once you have decided your stop loss, get out of that particular trade. If it has hit your stop loss, that's it. There is no question. If it is hits your stop loss and then goes back, then also nothing going. Okay. The safest thing is to always keep the stop loss order entered into the system and not merely made a mental note of. You are not monitoring the screen for modification of risk. In fact, there should not be any decision left to be taken once you enter a trade. The entire path must be chalked out before taking the entry. There is no point going on hoping if the trade goes against you. So the important thing which the author is telling is that don't have your mental stop losses. Uh, and once we have entered the trade, there is no decision. That's it. That's how we should enter. And from the entry till the exit, we should know that this is where we will enter, this is where we will lose, and this is where we will exit. Okay. So there is no point on hoping if the trade is going against you or something. Okay. Stop looking for some miraculous Viagra that might lift your collapsing stocks higher. Obey your stop losses. It is your emotion, false hope, your refusal to face facts, and probably your ego that are at play when you resort to such suicidal behavior patterns. The price may very well move in your favor after triggering your stop loss. So, what if it does? Nothing justifies modifying the stop loss midway. If the trade again moves in your favor, nobody stops you from re entering. But if the stock has not respected your levels at the given moment, you must dump it. You must promise to yourself that you will not hesitate when the time appears ripe for re entry. If that does not happen in the same stock, then you can always look for another stock. Okay. So don't modify the trade stop loss in between. And why we modify? Because we are emotional, because we are having false hopes, and because we are refusing to accept uh, that we were wrong and face the facts. And probably we are having that ego, right? We are not humble. We are not accepting that we were wrong. And that is why such suicidal patterns will happen. And the price will might move also after hitting our stop loss. So what? Okay, so even if it does, nothing is going to modify the stop loss. We that is nothing will justify modifying our stop loss midway. Okay, and now assume it hit our stop loss and it moves in our favor. Nobody is stopping from, we can always re-enter. Okay, and but if it has not respected our levels at that moment, and if it has broken our levels, it is not telling that I will stop there or something. We must dump it. Okay, and you should not re-enter until it appears, the time is ripe for a re-entry. Okay, and if it is not all respecting your levels, you should just look for some other stock. Once you are mentally free from losing trade, you can focus on newer opportunities. Your clarity will definitely be better once you are out of a trade gone bad. The smaller the loss, the easier and quicker is the recovery. Staying with the loss is no way to recover from it. Time is not the medicine for everything. Accepting facts is the way forward. Okay. So once that's it, now we have lost a trade and accept it that we lost a trade. Now, once that happens, that is when we will be open for newer opportunities. And what will happen? Then we'll be clear. Okay. And important thing is if the loss is small, you quickly recover. If it's a huge loss, that's it. We will be ruminating over those particular loss. We'll be thinking how to recover this particular loss, and staying with the loss is no way to recover from it. And important thing is if you are staying with the loss, you cannot recover, right? And just because you keep waiting hoping, that is not going to help you come out, right? Or time is not the medicine. So accept the fact and exit the trade. Total risk or drawdown value. Now we know that the maximum amount of risk allowed per trade involves two variables. One is the stop loss in points and the other is the position size for a given trade. This total risk amount is also called the drawdown value. It means that the total capital available for your next trade is lower by that much value. Say you started with 100K or 1 lakh and you lost 20K, the drawdown amount is then 20K and your available capital for next trade is 80K. So total risk or the drawdown equal to risk in points into number of shares, that is a position size. Drawdown per trade or total risk per trade should be lesser than 2% of total trading capital. This is what author is trying from the beginning. Don't lose more than 2% of your trading capital. That means don't have your drawdown value, greater than 2%. It should be lesser than 2%. Okay. Now comes the position size. So obviously here, if you have 1 lakh capital, if you lost 20K, now for the next trade you will have only 80K. So that is what the author is telling. Position size. We now come to position sizing, which is the main crux of this chapter. We strongly recommend that the upper limit for the total permissible risk per trade must be kept fixed at 2%. Now we know that this is called a drawdown amount. The stop loss in terms of points is a variable and should ideally come from the technicals and charts. Thus, this is not something which is in our hands. The only variable which we can control is the position size, and that is the money management. We divide the permissible drawdown per trade by the stop loss in points, and we get the permissible position size. Position size equal to total permitted risk in amount divided by stop loss in points. So for example, you have 2 lakh in your trading account Taking a risk of not more than 2% of the trading capital means a total permissible loss per trade of 4,000. If you see a trade set up on charts with a stop loss of say uh, rupees 6, uh, that is 6 points, you can afford to take the trade for up to 666 shares. That is 4,000 divided by 6 is 666. Holding it off, let's say you can buy up to 650 shares. Okay. So assume you have 2 lakhs in our account, and we can lose then 2% of that is 4,000. And you see somewhere you want to enter, and you can have a loss of 6 rupees, 6 points, which means you can take 4,000. If you can lose means 4,000 divided by 6, which is mean you can take by around 666 quantities, so that those 666 quantities, you know, goes down by 6 rupees, you will end up in 4,000 loss. So rounding it up, you make it as 650 shares. Okay. So with a stop loss of 6 points and a position size of 650, your loss per trade stays within the permissible limit of 4,000. So if the lot size in F&O segment is 600, you can afford to buy only one lot and no more. Okay. So if you lose 6 points, and that will eat up, uh, you know, your loss, then, and if you can buy, and say you if you want to buy 650 but there is only 600 per lot, then that is what one, you can buy only one lot. This method ensures that you never lose more than 2% of your total trading capital on a single trade. This is most important because it keeps you in the game for longer. Imagine if you go on losing 10% of your capital on each trade. You would be broke if 10 consecutive stop losses were to get triggered. And no, this is not very unusual. It can happen, no matter how good or bad you are. And if it does, it will wipe you out. As John Keynes said, markets can remain irrational for a time period that is longer than the period for which you can maintain solvency. Okay. So consecutively 10 times, it can, your trade will keep on hitting stop loss. Okay. And the author is telling that it can happen also. It's like, one day, today you lose, the next day also you lose, the third day also you lose, keep on losing. Or this trade itself, 3 trades, 4 trades, 10 trades, it will keep on losing. And it will sound irrational also, right? And it will be like, it will be irrational till you go bankrupt. So that is why the author is telling stick with the 2% rule. Drawdowns can really draw you down. You must have heard your share of interesting, read shocking stories from the 2008 stock market disaster, like those of Amtech Auto or Unitech. Here is another disaster story from then. A small stock called Shivwani Oil and Gas Exploration, one of India's largest oil field services providers, was quite a favorite among many market players at that time. The share price was around 700 at the highs of January 2008. By January 2009, in 1 year, the price was drawn to about 100 rupees, and it was rupees 6, yes, just 6 in early 2016 when lenders took over the company. The company boasted of customers such as ONGC and Oil India and investors like Franklin Templeton till 2010 who had faith in its capabilities. So what? What goes down need not come up, and when you want it to, and need not come up when you want it to. Got the point? And this is also applicable to blue chips, which too can erode very badly when markets crash. The major problem with drawdowns is that recovery from losses requires much higher rates of return or percentage returns. Okay, let us understand how. Okay, so the author is telling that the drawdowns can be really very bad, and he gave an example of how in one particular year, that particular company, Shivwani Oil and Gas Exploration, went from 700 to 100 rupees. And then in couple of 6 years, it went to almost 6 rupees. So just because uh, what goes down should come up, It might come up, but not when we want, right? Time will play its own. There will be a time correction also, and even blue chip companies can have very bad effect, right? Uh, Now the problem is what the author is telling is that it is not the drawdown, but recovering from the drawdown. For that you need higher rates of intra return. So we'll see how that is happening. The math behind the drawdown losses. If you incur a major loss in any single trade, your available trading capital goes down. Until you recover the loss, you cannot come into overall profits. The bigger the drawdown, the larger will have to be your profit from the next trade or from the next few trades. So to get back even to neutral in percentage terms, to recover from a 50% loss, you will have to gain 100% returns just to bring you to neutral level. Here is how. Suppose your stock goes by 50%, say it falls from 100 to 50. Now assume that it recovers again by the same percentage by 50%, that is a rise of 25 rupees. 50% of 50 is 25. So now the new value of your stock is 75. You're still down by 25% as you bought it at 100 rupees. Thus, it will take 100% profit returns simply to bring your capital back to its original level. A stock that goes down by 50% and again goes up by 50% is still down by 25%. Your first mistake was that of having taken a wrong trade. That can be forgiven. The bigger mistake is that of holding on to it for so long that the loss grows so big. That is unforgivable. Often traders stay with a trade only because they feel they have already invested time and energy into it. They need to remember that a mistake is the cheapest at the start. It only gets bigger the longer you stay with it. Never stay with a mistake just because you invested a lot of time in making one. Okay. So, the author says that, uh, the first trade you lose, and to recover from that, you have lost some 50%. Now, even 50% increase, it is actually from a 50% of the lower amount, right? So obviously, it is still you will be less by 25%. And because the first mistake was that we entered at the it was a wrong trade. Okay, and it's okay to make a wrong trade. That is not a problem. But the bigger mistake is we kept holding to it for so long that our losses grow so big. Okay, so that is the unforgivable thing. Okay, and because we keep staying in a trade because we have already invested time and energy, and that is the mistake is cheapest at the start. So when you started making a mistake, that is when you entered the wrong trade, at that time it was cheap. You can always quickly exit. But the more you keep making entering in, staying in that position, the time the mistake becomes costly. Okay, and so never stay with that mistake because you invested a lot of time in making one. Okay, take a look at table 12.2. It shows the returns that you will need to generate after various levels of drawdowns simply to reach back to your original level capital or to break even. This vividly highlights why you must control your total amount of loss per single trade. Okay, so if your trading capital, we have a 5% of drawdown, and to recover that from that we need 5.3%. 10, we need 11.1. 15, 17.6. 20, 25%. And if we have lost 80% of the drawdown, to recover that we need 900% of that particular uh, return. Okay, so that is why we say that drawdowns can draw you down, very down. If you operate this way, you will never make money. Okay. The moral of the story is that controlling the damage and limiting losses is far better than running after recoveries. Getting into a bad trade can hurt, but holding on to it can hurt even more. Okay. Sometimes holding on does more damage than letting go. Let it go. release it, and relieve yourself. Making mistakes is pardonable. Staying with a mistake is definitely not. Everybody makes mistakes. Winners are those who correct their mistakes and not those who stick with them and allow them to grow bigger. The mental damage of drawdowns. A drawdown is not limited to damaging your trading capital. It goes much beyond that. Drawdowns cause huge emotional damage that can last longer than the financial impact. Drawdowns can rob a trader of his confidence. If they happen repeatedly and are not controlled, they can wear off his self esteem. The impact can last for many trades. A drawdown can create desperation, and that can lead to hasty decisions. It can also send a trader into a shell, and he may shy away from newer trade ideas. That can lead to a lack of opportunities coming his way. He may be surrounded by others who may be putting on even false impressions of being super successful. That can add to his desperation. We will be dealing with this issue of handling emotions in chapter 13. So, obviously, here we saw about, sometimes you have the rope tied, it is bleeding your hands, leave it, and obviously you'll be at ease. And the important thing about the drawdowns is that it is not only bringing our trading capital, uh, it's not only damaging our trading capital, it causes huge emotional damage also. Okay, so what is the emotional damage? We will lose our confidence, right? And that is one thing. And if it keeps on happening again and again, you know, we will our self-esteem also will be questioned, right? And not only that, it will have an impact on uh, all the trades we take. We will be having a low self-esteem. Not only that, because of that particular drawdown, what is happening? We are having a desperation. Okay, what is the desperation? No, we had a huge drawdown. We are desperate to win that back. Okay, so we are like we are not accepting that we made a mistake. We are now desperate. We are you know we want to get that money back. And what will happen because of that? It can lead to hasty decisions because we are so desperate and we are trying to because we are desperate, we'll take hasty decisions. Okay. Not only that, because of that particular huge drawdown, we can also make the trader go into a shell. Okay. And new opportunities might be, the market might be giving you new opportunities. Uh, and the trader will not take that particular trade because of the drawdown, because we are scared of the drawdown. And not only that, there will be a lot of people who are putting false impressions of being super successful surrounding. Okay. uh, what is happening is everybody will be posting their m2ms and I got success today, I won and all these things. uh, but what is happening is out of desperation. Now that is also adding to our desperation, right? We'll see those things. We'll see those YouTube screenshots. We'll see all the verified by then all those verified by Sensible and all these things, and we will be desperate. Okay, so how to handle this? The author is going to tell it in the 13th chapter. Okay, what we are essentially doing with our money management system is that we are factoring in a series of consecutive losses and yet ensuring that we do not get thrown out of business. Survival is the key. Jaan hai to jahan hai, as the Hindi saying goes, so long you are alive, you can conquer the world. Okay. So this is the importance of the money management. What is the money management is telling? It is factoring in, a series of consecutive losses. Okay, so you can keep on failing consecutively, but ensure that you are not thrown out of the business. Okay, so as long as you are alive, you can conquer the world. So long as you are not forced to quit, there remains the chance of bouncing back. Okay, to keep going, you need both financial strength as well as mental strength. So you have to protect both. All said and done, financial damages leave bruises at multiple places. including on your mind. This becomes all the more important in leveraged products. Whether you earn or not, you will have to pay the mark to market margin. This creates immense pressure if mishandled. Okay. So you have to take care of your financial strength, obviously. And not only that, if you lose the money, there is a damage to our mental health as well. So you have to take care of the mental strength. And that is why money management is very important. Okay. So that you can handle that, you can bounce back whenever you are being hit by consecutively. So not only that, if you it not only does in these two things, it's also you have to pay back if you are taken a margin from the broker. So that is something which we have to handle, right? Factoring in slippage losses. Not all your orders will be of limit orders. Depending on your trading style, at times there will be market orders as well. In the case of market orders, there could be a sizable difference between the price at which you expected to get your order filled and the actual price at which it does get filled, particularly in a volatile market with high volumes. There could also be a runaway gaps during fast moving markets. All of these can result in entries at prices higher than anticipated and selling at lower levels. With regular trading, multiple trades a day, and with significant account size slippage, losses could add up to sizable amounts. A trader must factor in these costs of doing business. Also to be factored in is the cost of taxes and commissions. Commission costs can also vary in wide range, and you will be paying these not just on profits but also on losing trades. Okay, even if we lose, we will be paying, which is why you must negotiate a good deal from your broker. Anybody paying brokerages higher than the minimum is an idiot. These costs must maybe is a very small part of traders' middle line as a whole, but controlling them will definitely add to the bottom line. Okay, so there are some more things you just don't lose based on bad entry traders. Sometimes you'll be slippage also. So you will not all your orders might not be limit orders. Sometimes it will be market orders also. And because of that, you might want to enter at one point by the time you click, but it will get filled in a higher price. And from there, it might start falling down. And you're obviously, because if it had entered at a higher price, your stop loss has now widened. So uh, these are all the things you have to factor in also. So not only that, and there are also commission costs, and even if we are lost a trade, we will have to pay the commissions for the brokerage and for the government in terms of you know the STT and all. So author is telling that if you are paying more to broker, you have to uh, you know you have to fix it. Profit expectations. What is enough? As you sow, so shall you reap. There are no rules defining an average or an above average performance. A trader defines his own average. A good trader will make consistent money while a lethargic, undisciplined dreamer will help other good traders build their wealth by his daily market donations. What makes a winner is the allocation of capital and its risk management. We have seen that there has to be some acceptable ratio between the amount that you risk and the reward that you look forward to. The higher this ratio, the better it is for the trader. The upper side can be anything. There is no limit to it. History has shown people achieving 5 to 6 digit returns over time. It is only risk that needs to have boundaries. The returns must be better and bigger than the risk being undertaken in every trade. So how much now the loss we have accepted, but how much profit you have to take. So that is something which each and every trader you have to define your own. Okay. The goal is you have to keep on making consistent money. Okay. It's not like, and if you are, and but what will happen if you are not disciplined, if you are lethargic, you will keep donating money to these consistent players. And so, and how you do it is by how much capital you allocate and how much risk you take, right? And we have seen that there is has to be some acceptable ratio between the amount that you risk and the reward that you look forward to. So sometimes it might be 1:1, 1:2, 1:3. Okay, but author is not putting a number. He's telling that the higher it is, the better it is. If you are having 1:3, 1:4, and the upper can be anything. There are times where people have achieved 5 and 6 returns, right? So the return must be better and the bigger than the risk being undertaken in every trade. See, the author is telling them try to have a reward of more than the risk. Risk management mistakes traders often make. Traders often resort to practices such as averaging and hedging in order to manage risk. None of these can save you. Instead, you will get yourself deeper into the soup. There are also people who like to double their position size after losses. They do this in the hope of recovering multiple losses with one gain. They believe that just because they have been through a series of losses, their probability of victory in the next trade is higher. That is total ignorance about the laws of probability. According to the theory of probability, each individual trade has an equal probability of being a loser or a winner trade. The chances of profit or loss will always be 50%. So just because you have failed, say 5 times, it does not mean that you have any higher probability than the sixth trade will be a winner. Please do not harbor such superstitions. I have seen people adopting weird ways and means to guess whether a stock is a buy or a sell call, and then they blame the markets. In any increase in position size on the basis of such assumptions is an invitation to self-sabotage and fiscal suicide. Recovering money from a losing position is 10 times more difficult than making money from a winning position. Strong trends don't give up easily, and staying in their way is not the correct thing to do. So, one of the other mistakes which the traders make is that you average or hedge your positions and to manage risk. Okay, uh, what will happen is the author is telling just because you average in the lower when it goes against you and trying buying more the lower prices, it will actually put you into a deeper soup. Okay, and so sometimes after you lose a trade, you will actually double your positions. Okay, so for example, first time you lost 100, you had a lot, you had 100, you will purchase 200 the next time, hoping that because I have lost so many times, this time I will be winning. But that is actually wrong, and the each individual trade has an equal probability of being a winner or loser. So it's like 50%. It's like tossing a coin. So just because we have failed 5 times does not mean that the next time will be a winner. Okay, so such things are wrong, and some people he has seen weirdly guessing whether it will be a buy or sell, and then they blame the markets by such superstitious things. So I have lost, I've taken all this uh, trade. So after that, they will increase the size and they will lose again 6 time also, and then they will, lose the entire capital. And what happens is that they blame the markets also. And the author says that when you lose a position and if you try to recover that money, it is 10 times difficult. Okay, than when you make money from a winning position. Okay, so we are in a trend, right? In a trend of winning, we'll keep on winning, and uh, don't stay in their way. Okay, don't go against the trend. Buying options also does not mean risk management by any stretch of imagination. Leverage is a double-edged sword. Whatever generates high return will generate higher risk as well. If you put your entire trading capital into options and do not properly manage the risk, you can go broke there as well. With futures, the ratio of risk to reward is linear. So when you hedge your losses, you are hedging your profits too. Never forget that. On top of it all, you are adding to the costs, taxes, and commissions. Capital must be preserved, yes, but it must also grow. Else, there is no point investing your time, money, attention, and energy. The best thing is to understand and accept that losses are not worth managing. Just have the acceptable loss levels predetermined. cut your trades there and move on. Okay. So just because now the author is telling that, if you buy options, it doesn't mean that, uh, you're, obviously you when you buy options, you pay less money. You pay only the premium and you get the leverage. But it is actually a double-edged sword. So you can make huge money, you can also lose huge money. Okay. And if you put the entire capital in buying options and if you don't manage the risk, okay, we can broke, again, we can, lose our money there as well. Okay. But with futures, the ratio of risk to reward is linear, so it will go in up or down. Okay, so but when we hedge our losses, the profits will also be hedged, right? So don't forget that. On top of it all, you are adding to the cost. Not only that, when we buy, by means of different strategies, uh, we might be adding to the we have to pay the cost of the commissions, broker commissions, and the taxes. So okay. So if just because you're trying to preserve the capital, if it's not growing, it is of no use. You're spending our time and money and attention and energy. Okay. The best way to control risk is by knowing what you are doing. If you know your job well, both stress and risk will be easier to control. Okay. So if you don't know what you're doing, don't do it. Okay. So don't go randomly without knowing it will do and all these things. Okay. Just going. Your exit strategy is also part of money management. Money once earned must not be returned to the market beyond a certain predetermined level. That doesn't mean you refuse to stay with the stock that is willing to stay with you. But as the trend matures, as the profit grows, as major resistances approach, you must grow increasingly vigilant and have a definite exit strategy in place beforehand. It could be a moving average line, a particular pivot, your predefined target level, or 50% retracement, whatever it is that suits you best. The point is you must have an exit plan and stick with it. Those who trade multiple positions or contracts can even use partial profit booking. Okay. So just like how we enter, we should also exit. So we cannot keep on giving back whatever we earned. Okay. So you have to have an exit strategy. Don't always wait for stop losses to get triggered. You can learn a lesson without paying a price. In normal circumstances, we keep some buffer space in placing stops, and we don't exit whether out of fear or some other reason. But say you are long in a stock and you see a sudden negative news breaking regarding the company, something which is very common in stock markets, or there is a sudden macro news break like the one on the day of surgical strikes of Pakistan, then you don't need to wait for the stop loss to get triggered. In such cases, you can exit with a lower loss value. There could be also be a possibility that you realize that your trade is technically incorrect. Ideally, this must not happen, and you are expected to do your trade planning very diligently beforehand. But if it does, then you don't just keep holding and praying. You accept the mistake and exit at the earliest without waiting for the stop loss to trigger. Okay, so you are permitted to make mistakes, but not mighty ones. Always tell yourself, thou shall remain solvent. Okay, so just like how we have the exit strategy, when we have to exit, we have to decide. We should also know that, not always we have to wait for the stop loss to get triggered. If there is a very bad news coming, you get out of the trade quickly. Don't wait for your stop loss to get triggered. If you know that, my trade is wrong, I entered wrongly, although it should not happen, get out of the trade. Okay. So when can you increase your position size? A position size increase should only be considered after you double your trading capital. Say the lot sizes permit you to buy one lot for every 3,50,000, then you can buy a second lot only if you have 7 lakh or more in your trading kitty. The overall leverage must be maintained. If you are trading with a leverage of say 50%, that percentage has to be sustained. Often traders increase their position sizes without any such considerations. based purely on the strength of their conviction on a call. Well, nobody can stop you from doing so. The law of probability that we explained earlier will remain in play. The chances of success for a given trade do not increase or diminish based on your perception of the move. Also, just because a few trades worked out well is no reason to start increasing your position size. Okay, so if it is in 3.5 lakhs and you can buy increase your position size only it has doubled, and the leverage must be maintained. Okay, if you are trading with a leverage of say 50% and that percentage has to be sustained. What happens is that traders increase their position sizes without any considerations based on our convictions. Okay, and nobody will stop you, right? The market is has no rules, and there is nothing to prevent you. It is a you can do whatever you want, and just because, but we have to ensure that we stick with our discipline. Okay, and just because a few trades worked out well does not mean that we can start increasing our position size. Okay, each decision has to be governed by trading logic and math. Emotions have no place and must be kept strictly under control. You will make money only when you understand the emotions of others while keeping your own totally under control. Okay, so every decision which we make and has to be governed by logic and math. Okay, and you should not have your emotions uh, taking your decisions, and we'll make money when we keep our emotions under control and understand the emotions of others. Hit ratio and risk reward ratio. The ratio between the risk that you accept and the reward that you expect should always be 1 is to 2 or higher. This means that for every 1 rupee of risk, you must target at least 2 rupees of profit. Moreover, this expectation must be based on analysis and not wishful thinking. The success ratio can be as low as 50% or even lower. You can still emerge a winner provided you keep your losses under control and keep riding your big winners. With a hit ratio of just 50%, you still end up winning at the end of the month because of two factors. You never allowed your losses to exceed the upper permissible limit. You showed patience during the winning trades and achieved your targets. Okay. So even if this ratio comes down to 40%, you still are in the green. So author is telling that every time when you have a risk to reward ratio, it means that for every profit of 1 rupee, we should have at least 2 rupees of profit. And for every loss of 1 rupee, we should have 2 rupees of profit. And it is not some wishful thinking. He's telling that it is based on the success ratio also. So one of the thing is assume you have a success ratio of only 50%. That is, 100 trades, 50 trades only win. Okay, and each of these winning trades you are winning with a risk to reward ratio of 1 is to 2. Then what will happen is your losses will not exceed beyond the limit. Okay, and the other one is when your trade is winning, you are patient to go wait for the 1 is to 2 and you achieve the targets, right? So even if it comes down to 40%, then also you are still in the green. So now author is telling a table. So 100 trades we take, we have a hit ratio of 30% we won. Next, but every time the 30% we won with a 1 is to 2. So what will happen is we ended up losing only 10 points. Okay, and 50% of hit ratio, and if we have 1 is to 1, what happens is every winner we lost. So net gains is 0. So of no use. And 50% but we have 1 is to 2, then we have actually 150. 40% 1 is to 2, then also we have 20 points gain. Ride your winners. Yes, I know it feels great to book profits, but never do so prematurely. You may have often heard that nobody goes booking profits. That is not necessarily so. If you keep booking out smaller amounts of profits and refuse to ride profitable trades for longer, even in a giving market, then one big loss can wipe out multiple smaller profits combined. Staying long enough in profitable trades is as important as cutting off quickly from losing trades. Okay, money over the long term will be made only by a limited number of trades. The Pareto principle of 80-20 is almost always in play. As per this principle, 80% of your profits from 20 will come from 20% of your trades. Also, most of your profits will come from the trades that will return you amounts equivalent to 3 to 5 times the risk. Strong trends don't break easily and can go on not just for an entire day, but even for multiple days for those interested in holding their positions longer. We have seen many such charts in the previous chapters. If you happen to be with one such trade, your aim must be to ride the wave as long as possible. Remember, maintaining an existing position is also trading. So because strong moves don't end easily, we exit these only once they start going in the opposite direction to our position. The reason to continue holding should be that a trade is moving favorably. What most traders do is exactly opposite. They stick with a trade when they should be dumping it. They dump one when they should be sticking with it. Okay. So in this paragraph, the author is telling that he's asking to ride your winners, and obviously no one goes broke booking profits, but that's not me. Sometimes you will, our market might give more money, but you would have exited uh, quickly also. And and the author says that 20-80-20 principle, 20% of your trades will give 80% of your profits, and sometimes it will be 3 to 5 times. And if you don't stay with the trend, you will be not reaping the complete benefit of the trend. Okay, and the trend rarely comes, right? At that time you should basically continue to hold that particular trade. Okay. So, but what traders usually do, they will actually dump when it is giving them huge profits, when ideally they should be holding it, and they will not dump when it is losing. Okay. So balancing the hit ratio and risk reward ratio. If you think that the hit ratio is meaningless and you can simply focus on the risk and reward, then you might be making a mistake. There are various combinations of the two that make a winner, as we just saw in table 12.3. The trade outcome is the result of both the ratios, not just any one. Doing some further analysis, we derive the combinations given in table 12.4. It is important to understand these combinations as this would help you analyze your monthly trading journey better. Okay. There is something called the hit ratio and the risk reward ratio, and we have to balance. Okay. So the key point is that the higher ratio between risk and reward, you will be able to sustain profits despite a lower hit ratio or success ratio. So don't get carried by the desire to be right all the time. There is more to success than that. After all, there is a limit to which you can control the success ratio. That other factor is the amount of profit you make in trades that work in your favor. So hit ratio is the one which we saw, right? How much times you win your trade. And so the author is telling that it is if you think that 30% for is also 50, I make 40% hit ratio, but still I have 1:2. Don't that is also a mistake. Okay, and so it is a combination of these two, right? So hit ratio as well as the risk to reward ratio. So you have to basically have a um, you know you will be able to sustain profits despite a lower hit ratio or success ratio. So don't get carried by the desire to be right all the time. There is more to success than that. Okay, and here's an example. Okay, first case, he has a risk to reward of 1 is to 1, 1 is to 2, 3, 4, 5, and hit ratio 60, 40, 30, 24. Hit ratio is going down. Okay, in all the case, it's actually staying the same. Okay, and yeah, you would also note that as the reward goes on improving for every rupee of risk, you could stay afloat with lower and lower success ratio. Focus on both for a winning combination. Thus, for example, a 40% hit ratio and a 2 is to 1 risk reward ratio is very well known combination. After taking all the required precautions, if you are still in the red on any given day, then just remind yourself of a very famous incident. One day in 1976, Ronald Wayne, the less known co-founder of Apple Inc., sold his entire 10% of stake in Apple for USD $800. A few decades later, the same stock was worth some $62 billion. You are not the only one. Okay. So, yeah. So, manage the hit ratio as well as the risk reward ratio as well. Diversification as risk management. The first thing to recognize is that no amount of diversification can protect you against bad planning or poor implementation of technicals or ignoring money management rules. So, by itself, diversification does not spare you from the hard work. Diversification cannot protect you against ignorance, lethargy, or hibernation. Secondly, while diversifying, one must choose negatively correlated stories. If you are diversifying among three stocks, all of which are expected to rise or fall together, then it hardly serves any purpose. The selected scripts or sectors should ideally be expected to move differently. While these things are more relevant for medium-term position holders, short-term traders may choose to diversify depending on their trading style and account size. Okay, so first thing is, if you think that diversify, if I put my eggs in multiple basket, it will help me handle risk. That is a wrong thing because it will not, uh, help you for what is it called, our poor money management things. And if we don't, if you are not, if you are lethargic, if you are ignorant, even you will, all the 10 things will go bad. Okay. Now the next thing is, if you are uh, if you are having three stocks in the same, uh, you know, if one, there is no point, right? If all three are, IT stocks, or if all three are bank stocks, something like that, and if all will rise and all will fall, there is no point, right? And ideally, you should be like, having multiple scripts. You have few in IT, few in bank, something like that. And for these are actually relevant for medium term holders, right? But short terms may choose to diversify depending on their trading style and account size. They can choose more than one sectors that are currently flavors of the market. As we write this in the first half of 2017, real estate, PSU banks, capital goods, and even FMCGs were moving well. 2016 had been more about metals and non-banking financial corporations in moving in major way. At times, traders may also choose multiple stocks within the same sector for intraday trading. While you may know that today is the day for PSU banks, you don't know which one is going to surge the most. These are not negatively correlated, but still, if one of the banks rises less, the other may compensate by being the top mover for the day. Okay, so if we are taking, you know, uh, we may take multiple banking stocks, and we don't know which one will surge, uh, uh, higher, because they are not negatively correlated. Everything can go up, everything can go down. But if one uh, rises, the less the other might rise more, and that could be help you. Okay, so Yeah. So for long-term people, you chose negatively correlated stories, and short-term, author is telling you can choose the same sector. Okay. Uh, they are not negatively correlated. Obviously, if you buy all the different banks, they are all the banking sector. But that is what author is telling. One might rise less. You don't know which one will rise high or more. Okay. So how much diversification is needed? Neither too much nor too little is the ideal recipe. Diversification is all about not putting all the eggs in one basket. While it sounds simple, it is not so simple to implement. Having said that, it must be added that diversification does not mean you have 10 open positions at the same time, at one time. Overdoing diversification can cause more damage than good. You may give away gains from one trade due to a loss incurred in the other. One must know one's limits, keep practical considerations in mind, and stay within the boundaries. Remember, each open position demands time and attention. One must also remember that in case of a sudden carnage or sharp fall, no amount of diversification can help. Diversification does not mean you ignore stop losses. The basic reason behind diversifying is that the chart patterns may not necessarily work as expected. We have seen multiple ways to control losses, and diversification is only one. It protects you with the law of averages. A short-term trader will also have to keep in view the cost of overdoing diversification, since trading costs can multiply into big amounts merely due to a high number of smaller value transactions, plus the daily volume per trade. The penalties could include slippages, transaction costs, etc. Thus, much like leverage, diversification is also a double-edged sword. It reduces the losses in one position due to a sudden adverse move, but it can also reduce the profits in another position, which is working in your favor. All said and done, position size is the basic tool of risk control for a trader. It is easy to understand that 500 shares of something is always riskier than 100 shares of the same thing. Okay. So, uh, just because you diversify does not mean that it will be acting as a risk management. And if you diversify and all goes for a toss and you have not kept a stop loss, it will still create a disaster. So, and it will draw down your entire money. And not only that, when you diversify, there is also multiple costs, like because of smaller number of transactions, there will be slippage also. There will be, and so it's a double-edged sword. Okay, so at the end, ensure that position size is uh, kept in check. How often should you measure your performance? A day trader is in the business of capital defense. Unless he keeps regular track of his capital, he will not know how well or how poorly he is doing his job. He is expected to be highly objective in his approach. His aim should be to go home for the day in green. He doesn't get stressed in case something does not work out. He faces the consequences calmly. He keeps a close tab of his account statements. He never runs away from issues. He faces them upfront and fixes the issues whenever he can. Stress is the outcome of an inability to understand a situation and the resultant feeling that one lacks the resources or the ability to meet the situation or take remedial action. If you really know what you are doing, half the stress will vanish immediately. An objective evaluation of the situation at hand, the guts to face it upfront, and the ability to take timely corrective actions are the qualities of a solid day trader. Okay, so uh, you have how often should you measure your performance? Okay, so and the trader's job is to keep on looking at the capital properly. And if we don't know that, if we don't accept that we are doing poorly, we will not be, we will not be making money, and we have to be highly objective, right? If we are losing, we are losing. Okay, at the end, our aim is to go home green. Okay, and something is if we didn't you know do it well, uh, we don't get stressed. Okay, so we have to face the consequences calmly, and he keeps on looking at his account statements. Okay, and never runs away from his issues. Okay, so when you don't understand the situation, you end up in stress. Okay, so and the resultant feeling that one lacks the resources or the ability to meet the situation or take remedial action. Okay, so basically we feel inadequate. We feel that we won't be able to fix the situation. Okay, so that is because we are unable to understand what is happening. And if you really know what you're doing, half the stress will vanish immediately. An objective evaluation of the situation at hand, the guts to face it upfront, and the ability to take timely corrective actions are the qualities of a solid day trader. Okay, so you have to objectively evaluate your situation. Okay, and you have the guts to face it, and then you have the ability to take corrective actions. Okay, these three are very important. Failing is actually vitally important for big success. It changes you forever and for the better, provided you learn and retain the right attitude, provided you learn the right lessons. Failure is your best teacher. It's wonderful quote. It's very pretty much self-explanatory. Now, are you overtrading? One of the major issues that often afflicts many traders is the need to be always doing something. While day trading will keep providing trading opportunities every few minutes, not all of them may necessarily come under your purview at the right moment. Not all may be of equal quality, not all may have the support of volumes, news event, corroborating higher time frame technicals, sectoral support, or macro support. Just because a trap is laid out, you don't have to get trapped. Use filters as per your trading plans and take only the best trades. There are no borderlines that define over trading, but if you are taking too many trades without making money, that is over trading. So, the author now tells about over trading. Okay, so because every time we have this itch to do a trade, okay, but not all are actually opportunities, you know. So because we cannot simply sit watching the charts, we don't know when to click, we don't know when to buy, and sometimes it might seem like go up, but there will not be much of volume, and there won't be any news event, there won't be anything which will suggest that it should go up or down, and it could be just a trap. And but just because it is a trap doesn't mean that we have to get trapped. Okay, so we have to use our own filter, right? We have to take only the best trades, only if it reaches our level, only if it reaches our plans. We have to filter out those things. And the author is telling us there's no such thing as over trading, but if we are taking too many trades without making money, that is over trading. Okay, so making money in trading is something sometimes a lot of hard work. Sitting and doing nothing for long duration also takes a lot of effort after all. Trading merely to recover the loss from a previous trade is not technical trading. Trading for the sake of revenge does not qualify as technicals either. Take the compulsion out and take charge of yourself. Not doing anything is sometimes the best trade. It is not about the number of trades you take. Okay. So, just because we have incurred a loss in the previous trade, that is not, and we are going to trade again, that is not technical trading. Okay. So, and if you are trading for the sake of revenge, that is also not technical trading. And so basically, we are compulsive here. We want to trade, we want to recover the loss, we want to take revenge. And if you remove those compulsions, that is when you have to trade and you have to take charge of yourself. So sometimes you might be compulsive to take a trade, sometimes you might be compulsive to quickly jump into a trade. Stop. Don't do anything. Sometimes that is the best trade which you can do. And it is not the number of trades that you take, it is basically whether you're in profit or loss. So let us pay heed to Shivaji, the founder of the Maratha Empire and a master of guerrilla warfare, who said, "He who fights and runs away lives to fight another day." There has to be a good balance between patience during arrow sideways markets and quick reflexes when trading action is called for required. What is important is that your hands must not shake or hesitate when the time comes for pulling the trigger. Okay. That moment is not going to last forever. Especially in day trading, the window of opportunity stays open for a very limited time. So here, attack with full force at the right moment, do your thing and get out. Again at the right moment. If the scene on the field starts looking different, you cannot keep waiting till the end of the day. You must follow your predetermined rules and get out before you get thrown out. Heard that song from the Bollywood blockbuster Dangal? भेद की हाकर के बदले शेर की एक दाहत है प्यारे. Ignore the continuous bleating of goats. Hark the roar of the lion in the contest. Never overstay your welcome in trade. Once you master what is presented in this book, there is no reason to be scared of the markets, and there is absolutely no need of listening to multiple views and keep getting confused. Everyone may have a different view as technicals are highly subjective. So the author is telling that, just because you have to trade, don't keep on trading. Just you have to keep seeing the screen. There are times when who is the Shivaji, who is the master of guerrilla warfare, he says that you hit and run because you are staying alive for to fight another day, right? So there has to be good balance between patience and sideways also. And for that, and yeah, for that quick reflexes is needed, right? When it is going in a sideways, you have to quickly enter and exit. And at that time, you should not tremble. Okay, your hand should not tremble, and you have to attack with full force at the right moment, and you have to do your thing and get out. Okay, so quickly. So, and if it is looking different, and follow our rules and get out before you get thrown out. Okay, don't overstay too much. You're welcome, and don't have to be scared if you master everything which is present in this book. Till you book profits, everything is notional. We often tend to forget what is that you make or lose money only on the second leg of your order. That is when you exit. Until then, everything exists only on paper. In other words, exit is as important as entry, and focusing only on the entries will not take you anywhere. Risk management addresses this issue. Focusing on exists in losing trades keeps losses in control and keeps you alive and kicking for another day. Exiting from money making trades at the right time will ensure that you do not give away what you have earned. Moral of the story, keep booking profits at regular intervals. Okay, so it can go up and down and all these things, but there are two actions. Either you buy and sell or sell and buy. Either ways, you can you can at the end there is you can either win or you can lose. Okay, till that time it is only everything is on paper until the money either it comes to your bank account or it goes from your bank account. Okay, so focusing on exits in the losing trades keeps your losses in control and keeps you alive and kicking for another day. So basically, whenever you are losing and you are quickly exiting that trade, you actually keep your losses in control. Okay, and when you are making money and you exit at the right time, you also ensure that you are not giving away what you have earned. Okay, so keep on booking profits at regular intervals and quickly exit your losses. Keep your losses short and keep your profits more. Keep making getting the profits in your account. There is a lot of work that markets require of a trader. The rewards are equally interesting. If you are willing to shed some perspiration, then you can definitely fulfill your aspirations. मांगता है लागत में तुझसे हर बूंद पसीना पर मुनाफा बदले में ये जान ले बहत देती है बंदे एक की मेहनत को किस्मत का सादत परिणाम है प्यारा प्यारे दंगल दंगल The contest demands of you every drop of your sweat, but understand it gives back much. Luck favors and blesses a hard worker. Dalal Street is no less than a daily dangle. You either hunt or you get hunted. So you have to keep fighting. If you don't hunt, you will get hunted. So that is what this entire chapter is all about. With this, we end this particular chapter. Thank you.